Most of the time, we want to find the absolute best stocks to make money in the stock market. But here's the thing. Stocks are some of the most risky things you can buy. And what most people should focus on are ETFs, exchange traded funds. So what are ETFs for those that don't know? And more importantly, what are the best ETFs to buy right now? Let's go ahead and break it down. I'm going to break down what ETFs are, how I chose the ETFs for this video, and then run down the ones that I chose for right now, for 2025, and what I think is going to happen for the remainder of this year, which is 98% of the year left, I suppose. All right, so I'll put chapter markers if I need to, depending on how long this runs, but I try to keep these 15 minutes or less. Now, I do have an entire breakdown of the ins and outs of ETFs, but we got new people all the time. So an ETF is, again, exchange traded fund, ETF, those letters we use for short. The way I like to explain it, just for, just a quick explainer, use the word explainer a bunch of times, is this. It is an easy package for you to invest in a bunch of stocks in one sitting. And the advantage, one of the biggest advantages, is instead of you putting your money into one stock that may or may not be good, you can buy dozens, if not hundreds of stocks in one package. For example, I told y'all to buy Netflix, or I suggested strongly that Netflix could be a very good, not inflation-proof, a very good election-proof stock back in November. Y'all got the receipts? Go back and check that video. Netflix today did hit an all-time high. I told y'all, right? Now, if that did not work, because I'm not perfect, right? You could have gotten a technology ETF or an entertainment ETF, and you could have gotten Netflix plus 500 other stocks together in case Netflix did not do well, and that would have lowered your risk. Another example that did not go in my favor, I bought Intel a few years ago because semiconductor stocks like Nvidia and all these other companies were doing well. I bought Intel, I put several thousand, like $4,000 or $5,000 into it, and it didn't go well. What I could have done, and probably should have done, was buy an ETF that had Intel plus 300 or 400 or 500 other stocks, and I would have been better off and lower my risk instead of losing money in Intel. So an ETF has you lowering your risk because you're buying a ton of stocks in a particular area, whether it's the entire United States and buying a bunch of stocks there, or technology stocks or finance stocks or something like that. So that is one of the advantages. Also, you don't have to put in the work of research in the same way. I didn't say you have to research. I didn't say that, right? It is a different way. So instead of me, who is the CEO? How well is the company doing? All kind of stuff, and doing that 400 times, which is impossible to do. I just need to say, all right, what companies are inside of this ETF, especially, the top 10, 15, maybe 20 holdings, right? Because that's where most of the money is. Who is running this ETF? How long has it been doing well? That is really what I truly care about for that ETF. And then just let the ETF run. That's really what truly matters here. And that's it, right? When it comes to an individual stock, I need to know, what kind of products are you selling? Are you good at that? Who are your competitors? I really need to, I wouldn't say worry, but I really gotta research for individual stocks. Not so much for an ETF, because that's just one company, right? An ETF is hundreds, and if that one company doesn't do well, there are several other stocks in there to kind of balance things out. So those are some of the advantages. We're also gonna talk about some disadvantages and what about ETFs as well. The next part is, well, what ETFs are doing well now and what areas are you looking at? Remember, in some of the videos where we did talk about individual stocks, you will notice a trend. Finance stocks are doing well. There are reasons for that we talked about. Tech stocks have been doing well for a very long time. There are reasons for that. And then we've got some industrial stocks. Talked about Pownet, aerospace, things like that. Well, I'm taking those and kind of pulling those up and saying, hey, let's look at industrial ETFs, let's look at finance ETFs, and let's look at technology ETFs and kind of see how those things shake out. So that is kind of where we are basing things up. Working from those individual stocks that we know have done well, we talked about before, and moving up and saying, all right, those are doing well, but how can we lower our risk? Because things are still early, things are still up in the air. Let's see if we can still get the benefit of those stocks while lowering our risk, which is really what we all want to do. Make money, lower our risk. That is how we get to these ETFs. With all of that out the way, okay, now we understand. We're all on the same page. Let's go ahead and jump into the list portion. You always gotta have that background, that context, which is why we got chapters 2 for those who want to skip ahead. All right, now, so Invesco KBW Bank. I don't know why they named it this, but KBWB is a stock symbol here. It is a bank ETF, obviously, and I've talked about bank ETFs. I haven't talked about bank ETFs. I have talked about bank stocks. Now, I am more of a fan of the smaller regional banks. I've said this before. That's because I feel they have more room to grow. Fifth Third Bank is the one I mentioned, I feel like several weeks ago. But Wells Fargo is a company that I'm not a fan of, but they exist. I'm told that stock does well, and there are other stocks out there, other larger banks that have done well too. I expect banking regulations to be non-existent for the majority of these companies to continue to do well. We've also talked about SoFi and how SoFi has done well recently. You can check out that video and see how you feel whether you want to invest in SoFi, but I did all the pros and cons of SoFi too, so you can check that out as well. Up 21% in the last 6 months, up 45% in the last year. Next year is S&P Capital Markets. That stock symbol is KCE, up 22% in the last 6 months, up 41% in the last year. The difference between capital markets and just banks. Capital markets usually include like portfolio companies, hedge fund managers, companies that invest money. Think like a BlackRock, think like a KKR, an asset manager, companies that create and manage 401ks per se, versus just a bank. So that's kind of the slight difference there. Though, if you dig into the ETF, you may see some overlap between some of these. So that may occur. It might not make sense to invest in both of these at the same time. So as I'm going through, even though both of these are in finance, do look into these to see if it makes sense for you to own both in finance, both in industrial, both in whatever category, just so you're not duplicating and increasing that risk. You might want to just pick one from every category. Totally up to you, but I just want to put that out there so that you can construct your portfolio in the best way possible. And again, let you know of all the risks. And there is one risk across all of these that I will let you know about near the end, and it's something that's just out there for everybody, right? Next one here is more in the infrastructure side, is U.S. Global Jets, JETS. That is the ticker symbol here. So JETS, Jets. I'm not a Jets fan at all. The Jets are terrible. This ETF is not so terrible. It is up 38% in the last 6 months and up 46% over last year. However, it did have a rough landing in the middle part of 2024. If you look at a chart, and that's the thing, you can't just look at something and say, oh, it did this well and just call it a day. No, it is not just about performance in and of itself. If you do look at a chart, though, over the last year, you'll see that it did land. It absolutely crashed for whatever reason. I don't know if maybe Boeing was a part of it. I'm not entirely sure, right? And then it took off again I don't have a better phrase for it, but it did take off, and that is one of the reasons as to why it is doing very well right now. I mean, it is basically a Nike check mark where you'll see that it was bad and then it was really good. What does that mean for its future? I'm not entirely sure. So I do have an asterisk there, just so that you know that is one that I'm squinting at. I'm not sure. I'm not 100% sure if I would go very heavy into this. The other thing here too is this is one that was launched in 2015. This is one that my friend and I covered on a podcast we did back in 2021, and it was new back then. And it's just a funny name. Now, the funny name doesn't mean anything towards the performance, but just know it. Anytime it has a sharp and quick comeback, it's like, hey, what's going on here? So if you are looking into this one, really look into it. Why did it fall? Why did it bounce back? What do we expect from the airline industry? Though we have seen a lot of airline stocks do well, and we've seen a lot of travel stocks do well. So there are some pros and cons in that particular space. So do pay attention to that. Moving on to industrials, which the airline space does fall into industrials. The iShares US Aerospace and Defense ETF. I have been leaning heavily into the aerospace and defense sector for a while now. I told you guys about HowNet. ITA is this ticker symbol here, and this one is only up 16% in the last 6 months and up 27% over the last year. Now, the downside, one of the potential downsides when it comes to ETFs as a whole is this. You can reduce your risk, right? Because I'm splitting, right, my potential returns. Take a company like HowNet, right? HWM. I'll put the ticker symbol here if I get it wrong. But I can invest in a company like that, and last time we had talked about it, the stock was doing incredibly well, right? Put my money there, or I can buy a stock like this that can have that plus dozens of other stocks. So I'm lowering my risk because I'm not putting all my eggs in one basket. I could put it in something like this that lowers it, but my return can also be lower. So that is, do I want to risk it and make more and also lose more? Maybe. Or I can lower that risk and spread it out, but also could make less. Contextually though, remember, making 16% in 6 months in the past, right? We're not guaranteeing to the future, and then making 27% over the previous year, that is still very good. The average return for the stock market is just 7%. So this is still very, very good when we back out and say, what has the stock market done historically? So 16%, 27%, that is still quite good. So it's nothing to sneeze at all. Okay, so I would still take those returns, but I'm just giving you that. The other downside across ETFs as a whole, that is not just these here, you will run into some sort of expense ratio. An expense ratio is the cost for doing business for an ETF. They're usually quite small. We're talking 0.0% of whatever you're investing in. Usually Vanguard is like the least expensive, and you're paying like fractions, like literal fractions. I did a whole video on how much you would pay for these things, but they are very, very, very small. But do compare to see how much you would pay. Some are more than others, but again, I didn't want to make this a 30-minute video, but do research those as you're pulling them up to see which ones make sense. And again, I did a whole video on how you can find out the fees and which ones make sense and all that kind of stuff. But again, usually very inexpensive. The iShares and the S&P ones are usually the least expensive, just as a hint there. All right, next here is the Global X US Infrastructure ETF, also known as PAVE. This was very popular during the infrastructure bill era several years ago. Up 14% in the last 6 months, up 29% over last year. Again, infrastructure bill, it was still a thing, and it is still money being paid out. So pretty solid. I talked about that one several years ago. I'm not going to beat you over the head with that one. Next one is the Roundhouse Magnificent 7 ETF. We talked about the Magnificent 7. We talked about the Batman stock. You don't know what that is. You know now, okay? That ETF is up 23% in the last 6 months and up 62% in the last year. So that one's an interesting one. I didn't say the stock symbol there. PAVE was the infrastructure one, and then MAGS, M-A-G-S, was the one for the Magnificent 7. If you are looking for an app to perhaps just invest in general, or look and research these ETFs or any other ones, then you want to check out one of my favorite investing apps. There is a lot of noise in the investing world, and it can be overwhelming to figure out what to invest in, how to start, and how to be consistent. Because of that friction, that fear, and that frustration, some people decide not to invest at all, and that means that you are not going to be able to grow your wealth. Well, what if there was something, an app perhaps, that can help you to invest and make it easy and to help you be more consistent as an investor? That is where M1 Finance comes in handy. You can choose your investments and set a target, how much you want to invest in each stock, and they will take care of the rest. Or you can choose one of their pre-made investment pies. For example, right now, this is an 80-20 portfolio. This is a good mix for me, and I've added it, and I am good to go. You can also get a higher interest rate on your uninvested cash with a high yield cash account. With my link, you can get an extra 0.5% on top of the current rate. Check out M1 Finance with the link right here. All right, back to the video. Getting back to the list, let's go to Invesco. This is the Momentum Tech ETF. This one is up 23% in the last 6 months and up 43% over the last year. I am a fan of momentum investing. What is momentum investing? Just a quick summary. This is you invest in what's doing well and you hop on the momentum train. All right. So if it's doing well, you invest in it and you just keep riding with that until such a time as it is not doing well. So looking at the list, is one of the ones that is doing the best, other than the banking stocks that we had talked about earlier. So that is one that you absolutely want to add, and I'll make sure that the ticker symbol is added here. And then we have the micro sectors FNG plus ETN ETF. It's the weirdest title, okay, but it's micro sectors FANG. I said it wrong, and ETN ETF. The ticker symbol, I had to get my computer just to, because I couldn't read my own handwriting. The ticker symbol is FNGS. It is based on the Bank of Montreal. It's just an interesting ETF, but it has done quite well, up over 23% in the last 6 months and up 54% in the last 6 months. So we did by default save the best for last. So these are the ones you absolutely want to check out if you are not just investing in a general index fund like just the S&P 500 and you kind of want a bit more specification and you're looking to get into more of a specific area. Then I would pick maybe one or two of these to research, see if they fit for you, and obviously check those fees and see which one fits. What's the best fee, and is a fee too much? Again, there are ways to check, and you definitely want to check out that video if you want to learn more about investing in general and how it works and how to check those fees, and whether you're paying too much or how you can perhaps even pay less. Then you want to check out these videos right here.